Welcome to Market Monday from the investment team and the trust department at the First National Bank. We're coming to you today on a Tuesday. I was out yesterday and unable to get this video out, but there is a lot to talk about, so let's get right into it. Firstly, we're going to start with the economy again, which was our practice for most of the recent history, up until a couple of weeks ago when the banking sector took front and center and really drove whatever the market was considering and thinking about. That is largely receded into the background. Concerns there seem to have eased somewhat, and markets have resumed looking at where inflation pressures are coming in, which will tell us how aggressive the Fed needs to remain or eventually get in its rate hike cycle, or are we headed toward or already in a recession? And those data points are coming pretty heavily over the next couple of weeks. So let's talk about them. We already got yesterday some information on wholesale inventories and trade. That information shows that both numbers came in a little bit lighter than expected. But that's not conclusive information at the moment. We really need to see what's happening with retail sales in order to make sense of what's happening with the wholesale. So we're going to come back to this one. Tomorrow we get information on the Consumer Price Index, which is expected to show growth of 0.2% on a month-over-month basis, which, although that's lower than the 0.4% that the prior month period had, it's still a positive number. That means it's not shrinking. It just shows a decelerating rise in inflation, but still a rise in inflation. So these numbers are problematic. They show that the Fed may still have work to do, particularly if it comes in hot. Annualized figure of 5.1% is still a very large number relative to what we're accustomed to over the past several decades. So it's going to be interesting. But later that day, we get the Federal Open Market Committee meeting minutes, and that's going to give us a clear insight into what was being talked about at that meeting, what their concerns were, what their insights were, what did the debate center around, and where is everybody lined up in terms of their leanings for future action. And markets seem to have priced in that the Fed is either at the top or near the top of its rate hike cycle and potentially going to be cutting rates later in the year. And hot numbers in the Consumer Price Index tomorrow or the following day when we get Producer Price Index, that could actually spook the market a little bit because of that, because it appears that those things are priced in. But we get Producer Price Indexes, and that's expected to show zero increase, so flattening out. And again, if that number comes in a little bit hot, it could lead to volatility. We get information on retail sales also, and this is where it becomes important. So retail sales are expected to show a decline of 0.4% on a month-over-month basis, consistent with the prior month, and that is a recessionary indicator, especially taken in the context of growing inventories and lower sales at the wholesale level. That suggests that retailers are stocking less, potentially guarding their balance sheets going into a potential recession. So it'll be interesting to see what this number comes out at, but this number could come out negative, worse than the 0.4%. That might also make markets a little bit skittish. We'll get information about manufacturing and sentiment, the real estate market, and closing out the next 2-week period, more information on sentiment. And these things are driving markets. And it's worth talking about rates and the hiking cycle, in that context. We're seeing rates that are consistent, this shape of a yield curve where it's inverted, and the 2-year Treasury is quite a bit, more than 60 basis points higher in yield than the 10-year Treasury. That telegraphs that the expectation is that we're going to be entering a recession sometime fairly soon. And the New York Fed actually puts out an indicator to this effect, probability of recession in the next 12 months. And it's interesting to note that anytime this indicator's been above a 40% chance of recession, or even lower than that in most cases, we have actually seen a recession, and it's up there pretty high at 57.77%. We're taking that as a signal that probably we are headed into a recession. But what does that mean? Does that mean that markets are going to tank? We don't really think so, because when you look at the S&P 500, there's a lot of strength down here in that 3,800 area, and the market appears to be holding pretty strong now around 4,100. It has to get above 4,200 to really start another bullish move higher, and it has to get below 3,800 in order to show a bearish move lower. And we really don't see either of these two things happening in the near future. Markets are a discounting mechanism for 18 months plus out into the future. So it is theoretically possible that we're expecting some news, and that news could even come in negative. Yes, there is a recession on the horizon, and we could see markets go up because they're already looking forward past them to the recovery. So we'll be paying attention to that. We'll also be paying attention to bond yields because these are really pretty good. It's not as good as it was a month ago, but it's still pretty good. 1-year paper almost at 5%. 5-year paper is over 4%. 10-year, we're getting back up to 5% at 15 years. This is a pretty strong, robust amount of yield for income investors. So again, headlines got a bit scary over the past few weeks, past month or so, and the market showed pretty good resilience. And when we zoom out over the longer term, which is where we're focused, we're seeing some strength. We're seeing what looks like a bottoming pattern happen over there, and we would expect the potential for markets to go higher from here, even in the event of one of these recessions happening, which, to be clear, we're currently at about 3.5%, under 4% unemployment, and that is a level beyond what's considered long-term sustainable. If we do have a mild recession that takes us to a 5% unemployment, that would still be considered a full, sustainable, long-term level of employment for the economy and consistent with strong market results over time. If you've got questions about your portfolio, if you've got comments that you'd like to share with us, please get in touch. We're happy to talk. Hope you find the video useful. Thanks and have a great day.